What's up, guys? Welcome to Roensch Capital Charts. Today we're taking a look at the ever so popular S&P 500 ETF SPY, ticker symbol SPY, on a variety of time frames in anticipation of the next trading day, Monday, May 20th. All right, guys, SPY on Friday closed the day up 76 cents per share. That's plus 0.14% in regular trading hours. Now you can see here, it looks like it's up in the after hours. However, the close is a little bit deceiving. If we zoom in here, you can see that the closing candle was actually on kind of a pop and then a fade, right? So it's actually up just a little bit, or it was up a little bit in the after hours. Either way, volume is very low. Take that with a grain of salt. I would call that essentially flat. But listen, we're going to take a look at the volume profile, pull out any bias that's kind of hidden underneath the actual intraday movement. Then we're going to take a look at the psychological levels. Of course, big money, institutions, and retail are all looking at that, so we're going to have to take a look at those as well. We'll then finish out with looking at implied volatility, highly important for you options traders, and then the expected move for Monday, and the directional bias coming out of the chain for tomorrow, Monday. So let's get started here on the 5-minute chart, again, with that volume profile analysis. The idea here, guys, is to take a look under the hood. The movement is what it is. It already happened, it's over, it's clear, we can all see it. But if we peel back a layer of the onion, right, we can actually pull out more information, some potential directional bias, bullish or bearish, kind of hidden underneath the waves. Now listen, by the way, guys, if you haven't done so already, or if you're new here, SPY is a daily upload. I cover this thing in preparation for every single trading day, so I appreciate you subscribing to the channel. My goal here is 10,000. I appreciate it. Let's take a look. Now, the name of the game here, guys, you guys know, is context, right? Context is very important because we expect volume to be higher or lower at certain times of the day. At the open, we always expect higher volume. We then typically see a big fade. We got that. There's really nothing out of the ordinary here to pull out. So we go through the day, there's a few pops, nothing extreme enough to really assign anything to this kind of like late morning, early afternoon portion. Very, very normal. Nothing at all going on there. Couple pops here. Again, too much of a risk of fooled by randomness on this little like stair-steppy up volume profile. What I'm really looking for are consecutive bars that are outside of the range, higher, right, of the volume we typically expect at that time of day. Consecutive, right, to kind of break that risk of fooled by randomness. Here, we're not really seeing that. We go through the day. Quite a few green bars consecutively, but we're getting a little bit of a pop and then a quick fade, little pop, fade. They're not consecutive and out of context, unfortunately. And then heading into the close, pretty normal. What we get here, guys, is this really high volume green bar. What is that? Right, a lot of you guys probably know that that's going to be a rebalancing bar. Okay, this one after the bell as well, also rebalancing. Now, this here is a little bit bizarre. We typically don't see like a pop after the fact, 10, 15 minutes into the after hours. But listen, two things going on there. The volume really, really quickly faded after that. And if you actually look at that bar that occurred on, very large wick, which leads me to believe that there was a lot of buying and selling pressure going on, clearly, on that bar, which pumps up that volume. So, interestingly, we had this like dump off and big run, at least, in relation to the size of the movement the rest of the day on SPY late in the day on Friday. But in terms of bias, there's really nothing clear. So let's move on. Let's take a look at the psychological levels heading into tomorrow. Now, guys, these are the levels that are the most obvious. You'll notice that my charts, the 30-minute, we'll look at the 4-hour, and the daily are very simple. I have the white line, the 50-period moving average, and the gray line, the 200 period. Again, these are very simple on purpose. The reason is because I'm only interested in doing TA around levels that have a big following, so to speak. What I mean by that is I don't want to look at a 27-day moving average, or 27 period, I suppose, on the 30-minute moving average that no one looks at. Because it doesn't mean anything, because it's all a self-fulfilling prophecy. So I want the most simple, and I want them to have the most amount of eyeballs possible. So here, really interestingly, the 30-minute from Friday, you can see that we gave it up on Thursday. Okay, that 50 period. We rejected downside into the close. Well, on Friday, we were struggling throughout the entirety of the day to reclaim that 50 period, very clearly acting as a psychological point of resistance. And we reclaimed it, tested it again, and bounced into the close. Now, it was not tremendous, but that's not a weak break and hold, right? We got it. We broke through, retested it once or twice, and then bounced away. That's on, granted, a higher volume, right, into the close. That's not a bad thing to see. So listen, bulls, tomorrow, Monday, any retest of that 50 period, I don't care what volume it retests on, okay, as long as it comes in and then tests it and bounces away on higher volume than the test. The reason I say that is because we're closed on Friday, already above the level, so the retest itself, the volume is a little less crucial. Now, bears, for you guys, you have to get down through the level. Typically, that requires some kind of momentum. Volume is very helpful in also being not only contributing to momentum, but also getting a big sample size agreeing with a downside break. So bears, you guys want to see a downside test of the 50 period with a high volume downside break. Then you can move into the low volume retest and boom, a high volume rejection, pushing down potentially for a near term test of the 200 period. Now let's move on to the 4-hour chart here and take a look. You guys can see here, we are a bit away from anything that's actually specific to the 4-hour. It's about 1.25% to the downside away from that 50 period moving average. So listen, if we were to see a big red day here tomorrow, all of a sudden this is back in play. And that 50 period is an area of potential interest that I'll be paying attention to. Aside from that coming back into play, I'm keeping the 4-hour on the back burner, okay? Because anything that we can do here that's not the 50 or the 200, we can do better on the daily. So let's do that. Let's take a look at the daily here and we can see, 530, guys, has been a very tough level to break and hold the last 3 trading days. We're right around all-time highs here. Of course, hitting that on Thursday. But the story here on the daily is very clear to me come tomorrow, Monday. Bulls, the goal, break and hold 530. Actually claim that as an area of true support, which means a break upside through, a retest, and a hold, the hold being a bounce. Okay? An additional all-time high on top of that would be a great cherry on top. Okay, that would be about 531.52-ish is the previous all-time high. In doing both of those things, the bulls accomplish a couple of things. They accomplish holding a new $5 or $10 increment, really $10 increment, I'd say, as a psychological support level, at least in the short term. And any new day where you're hitting all-time highs is a good way to keep the spirits of the bulls up, and we can't understate that. In the short term, this is all psychology. Right now, bears, for you guys, what's the goal? Well, it's really to form I would say, technical / psychological area of resistance, which is kind of already formed, 530. So ideally, what you guys are looking for is to confirm that with any retest of 530, rejecting hard. And I would say the best case scenario for bears is to reclaim 525, 520, really. But, understand that anything over a 1% move, plus or minus on SPY, is a little less common, right? I typically look at any move that's plus or minus 1% or more as a relatively volatile day out of SPY in particular. The Qs tend to be a little bit more volatile, but SPY, plus or minus 1%, that's a volatile day. Now, implied volatility, really important for those of you trading options. Look here. The lowest it's been, we're comparing to the last 3 months right now, and we are at the absolute lowest we've been in the last 3 months. So understand, if you're holding options that you bought, calls or puts, you're likely experiencing some IV crush right now. This is your culprit, okay? And if you're thinking, hey, I'm looking to buy options, either calls or puts, now might be a favorable time to do so, being that you're paying, assuming you have a strong directional bias, right? Because you're paying less Vega value up front. Vega is the Greek term of how the pricing goes into the contracts from implied volatility. So when IV, implied volatility, falls like it has been, compared to the last 3 months, then the Vega value in those contracts is low. And when you're buying, that means you're paying less up front, which is a good thing, okay? Because it can also flow back in if IV rises. And if you own the contracts at that time, that's called IV pump. That's good. Now, expected move here on Monday. We have the luxury of daily expirations on SPY. So the next expiration is Monday, May 20th. The expected move by tomorrow's close compared to Friday's close is plus or minus $2.07 per share. Okay, that's the volatility expectation, which is a crucial point to be aware of on top of your directional bias. Because of course, when you're trading options, just having a directional bias is not enough. You also have to have a directional bias and a volatility bias. Typically, ideally, one that disagrees with what the market's pricing in. Plus or minus $2.07 is the market's expectation for SPY's volatility by Monday's close compared to Friday's close. Now, directional bias, you're probably saying, okay, what about directional bias? Well, from Friday, we had 5.76 million total contracts traded. 2.44 million of those were calls and 3.32 million were puts. So we are seeing a bearish bias on the overall call-put ratio from Friday. But if we go one step further, break that down by time frame, we go 0 to 20 delta range. Those are going to be the short-term speculators. 795,000 calls in that range and 1.51 million puts. So a bearish bias out of the short-term speculators as well. Listen, guys, if you're getting value out of the daily SPY uploads, the absolute best thing you can do for the channel is fast and actually free. Just leave a like on the video. Helps out tremendously. And then get out of here and enjoy the rest of your Sunday or your Monday morning, depending on when you're watching this. I appreciate it, and I'll see you in the next one.